Good afternoon, my people. What is going on? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. I welcome each and every one of you to episode 201. The 15 days of Christmas comes to a wrap with day 15. So, before I get started, it's the holiday season. Everybody should be out here in a festive mood, depending on, what you celebrate, what you believe in. It's all types of love and joy and good tidings going on. So I, of course, have to start with the attitude of gratitude. Thank each and every one of you for being with me live as I stream across the Wealth Our Way Facebook page and the Wealth Our Way Network YouTube page. I also want to give the Wild Nation salute to the many members of Wealth Our Way Nation who watch the program in its pre-recorded state overnight, on the weekends, wherever they can squeeze 15 minutes of financial literacy in. And then last but not least, a heartfelt how are you to the good folks on the Life 101 platform who listen to the audio recording of this very here program. We are at the end of the year, good people. Give you some housekeeping notes. We are going to have a financial power hour tomorrow night with two brothers that I love and respect, Doug Reed and Reginald Howard of Black Men Heal. We're going to close out the year, wrapping up our conversations around health and finance, the intersection of the two, with a special focus on mental health, because this time of year is incredibly taxing on many people's minds, hearts, and soul. And, we're going to give special deference, dare I say, to Black men and what we go through as providers and leaders in our homes and communities at this time of year. Everybody probably has heard at this point of the suicide of the brother DJ Switch, Twitch Switch. Forgive me for not knowing, but I'm not an Ellen DeGeneres viewer. But the topic has been very much buzzing on social media, and it just brings to light that no matter who you are, public eye, not in the public eye, outgoing, introvert, doesn't matter. Mental health, the stresses of life, just overall well-being of people is always something that we should concern ourselves with, our own and that of our fellow human beings. So we are going to be here tomorrow night on the Financial Power Hour with the representatives of Black Men Heal discussing mental health and wealth. What I also want to tell you is that's the last program of 2022. We will not do, we do the Financial Power Hour every other Wednesday. So with tomorrow being, what is tomorrow? The 21st. So there's one more Wednesday in December. So we won't be on again in December for the Financial Power Hour. And I am giving myself the week off to spend time with family and friends next week. So there will be no 15 minutes of finance in the final week of December. We will see you guys all live first Tuesday in 2023. I am looking forward to wishing you all a happy new year. So we are closing out the 15 days of finance discussing employer-sponsored plans. I gave you guys two very important tips last week, and I'll recap. I said that if you are contributing to an employer-sponsored plan, I suggest that you contribute up to the point where your employer stops matching your contributions. If your employer doesn't match your contributions at all, then you may want to seriously just consider step 2, which is moving to a Roth IRA outside of your job, going to a no-load brokerage account. I believe, what do you have? Fidelity, you have Vanguard, you have Charles Schwab, Ameritrade. There's a plethora of different no-load platforms that will allow you to open up a Roth IRA. The other thing I'll say is this. A lot of employers have gotten on board with adding the Roth IRA to their employer-sponsored offerings. So make sure you may not have to leave the company to do your Roth IRA. You can go up to if your company offers both traditional and for Roth 401k, I would go up to the match in my traditional, and then I'd switch over to the Roth and do the remaining amount that I'm budgeted for. that gives you the ability to exceed the $6,000 contribution limit that 2022 has for people who are under age 50, and 7,000 for people who are 50 and older with the catch-up contribution, because you fall under 401k rules instead of Roth IRA rules. So if you're doing a Roth IRA or a traditional IRA in a brokerage account, then you're subject to the $6,000 contribution, and you get to do $1,000 additional if you're 50 or older. But if you're doing it at an employer sponsored plan, now you can go up to 15% of your income, up to $19,500, I believe, in 2022. Big difference for what you're able to put away. Let's talk about the Roth IRA contribution for people who make more money than is allowed by the law right now, because it's very important. If I'm giving you advice that says match your pay, contribute up to the match for your employer sponsored plan, and then go to a brokerage account and do a Roth IRA. If the first thing out your mouth is, Tank, I make 170 grand and I can't do a Roth IRA, you seem to be getting bad advice from me. But I don't give bad advice here. So let me give you the complete story. What you would want to do is you would want to do what's called a backdoor Roth IRA. And because some people like me have just very fresh and silly minds, I think they need to come up with a better name than the backdoor Roth IRA at some point. But right now, that's what we call it, the backdoor Roth IRA. And it works very, very simply. When you open an IRA, you have the ability to let the IRS know that you opened an IRA and that you choose to deduct your contribution. It's a affirmative action. You have to do it. They don't just assume to deduct it. You have to choose to let them know you want to deduct your contribution. Conversely, you let them know you don't want to deduct your IRA contribution by selecting a non-deductible IRA. So if you select a non-deductible IRA, you can immediately transfer or do what's called convert the contribution that you put into this non-deductible individual retirement account. You can flip it over to a Roth IRA. That is how you get around the income limitation, because there is no income limitation to be able to put money into a traditional IRA, and there is no income limit on your ability to convert a traditional IRA to a Roth IRA. So it's a two-step process instead of a one-step process. You put your money into a traditional IRA, you don't deduct it, and then immediately you move it to a Roth IRA. Why do I keep using the word immediately? Because you don't actually want to make any money in your traditional IRA, because if you convert more than you contributed, you will pay tax on the gain. So if you do it immediately, you won't have any gain. You put the money in on a Tuesday. By immediate, I mean the next day. It has to settle in your account. The next day, you convert it to a Roth IRA. Even if you parked it in the money market account for one day, in that one day of processing, you shouldn't make any money. If you make a penny, you'll go pay taxes on your penny. But doubtful that you will have made any money in that one day process. So that's how you get to the Roth IRA if you are exceeding the income limits, which are, in my opinion, rather low. I think it's $144,000 for a married couple, or $144,000 for an individual and $170,000 for a married couple, something really low. I always tell you, when it comes to me reciting numbers, go to Google and check my numbers, because I deal with numbers all day, so they get jumbled in my head. So I think it's $144,000 for an individual, $170,000 for a married couple. You got two people making 90 grand. All of a sudden, you can't contribute to a Roth IRA. So do the backdoor Roth IRA to take advantage. I told you that I would give you another portion, because in the example of the person we used last week, their budget meant that they could afford to save/invest $15,000 for their retirement. But I gave them two examples that only had them putting away $12,000, $6,000 in their company plan up to the match. Then he moved over to the Roth IRA and did the next $6,000. That still leaves $3,000. And if your budget allows for you to invest or save $15,000, invest or save $15,000. Don't cut yourself short. So what do we do with the next $3,000? You have to examine. So in my book, the 5 major money moves and 3 money must do's. I talk about my acronym BUD, best use of a dollar. When you grow your net worth, which is what we're always trying to do at Wealth Our Way, we measure people's net worth and how it improves. You increase your net worth by doing one of two things: by increasing your assets, those are the things you own, and decreasing your liabilities. These are the things you owe. So own, owe. We want to increase what we own. We want to lessen what we owe. I just gave you 2 tips to increase what you own. Increase your retirement plan at work, increase your brokerage retirement account. Now I'm going to direct you to look at what you owe. And if your debts cost you in the form of interest more than 6%, I would encourage you to attack paying those debts down. Why is 6% my magic number? Well, the reality is that the stock market historically returns 10% a year. The S&P 500 historically returns 10% a year if you reinvest capital gains and dividends. None of you guys should be 100% invested in the S&P 500, although I've seen crazier. With that being said, your expected return, if you're 100% in the S&P 500, would be 10%. And then, of course, there's some expenses that come with owning investments. So let's say that totals 1%. You're expecting 9%. 9% after that 20% capital gains tax, or just a regular income tax if we're in a retirement account, is another 2% from the 10. You're down to around 7%. That's if you're 100% invested in the stock market, which I encourage nobody to be. So if you have a more conservative mix, like let's say 70% stock market, 30% bond market, or 65% stock market, 30% bond market, 5% cash, your expected rate of return is closer to 6%. So if you're going for an over time rate of return of 6%, that's going to fluctuate up and down because these markets fluctuate up and down. Why would you not attack a debt that has a 6% expense attached to it that doesn't fluctuate? You guarantee you're going to reduce your expenses by 6% by paying this debt down. Now, most debts that you're going to have are significantly higher than that. Credit cards are in the teens or 20%. Car notes can be 7 or 8%. Now mortgages are rising back up over 6%. So I would suggest that the last thing we do, it seems counterintuitive to say we're saving for retirement by paying down a debt. But if you get the best use of your dollar by attacking a high cost debt, it will do as much for your net worth as growing your 401k, as growing your IRA. So that's my third tip. The tips for today are: if you are above the income limits when it comes time to create your Roth IRA, use the backdoor provision. And after you've maxed out the company match on your 401k and you've went and maxed out your Roth IRA, if you still have money in your budget to save, use that money to pay down high cost debt. I want to thank each and every one of you for making 2022 an amazing year for me, making an amazing year for the Wealth Our Way family. I love each and every one of you. I thank you for your support of the Facebook page and the YouTube channel. I continue to commit to making sure that the knowledge that I have is shared amongst my friends and peers. And I want you guys to always remember, wealth is not only for the wealthy. Happy holidays. Have a happy new year. Take care.